And today's burning question is, how much of a mortgage is too much? This is such an important question. How much is too much? Because if it's too much, things are going to fall apart eventually, and then you're going to lose the thing, the house that you were trying to own over time. If it's not enough of a mortgage, well, you're never really going to achieve the full potential. So it's really important to consider this question. How much is too much? And find your own groove within that lane. So, as a bit of context, back when I was a kid, a large mortgage, and this is going back, late 80s, a large mortgage would have been about $100,000, right? Or close to that, more or less. And we've all heard stories about what our parents thought high mortgages were and high interest rates, and they're both very different to what we get today. And it kind of made sense, though, to have mortgages like that back then because interest rates were double digits and a bottle of milk was like 20 cents. Nowadays, it's not unusual to come across people with a $1 million mortgage or much, much more than that. And I know many of you are striving to make the best use of everything that you have, your time that you have and your money that you have, like the actual cash, the equity, and your income. You're trying to do the best you can. And therefore, you're most likely going to be talking to a bank at some stage to leverage up to take more ground. And I also know that due to recent interest rate hikes and a rising cost of living thing that's going on as a result of out of control government spending and templated central bank policy, by the way, it's now a little bit harder to get things done. But as long as we maintain the right amount of debt during our working lives, we can still build a much better future for ourselves and our families. So I've helped countless people over the years secure mortgage funding as a financial advisor, sometimes for the first home, other times for the dream home, or even just investment properties. When the question comes up of how much of a mortgage is appropriate for me, what these people often want help with is finding the balance between trying to get ahead and trying to stay ahead. That's that blend or that balance of having too much or not enough. And this requires a general sense of what a bank will likely allow you to do and what position you know you can sustain over time. Now, banks generally lend around 4 to 5 times your gross taxable income. At the time of recording here in May 2023, that's true. Now, how much deposit you have, or what your equity is in the property, your expenses, your age, and what you're buying, amongst other things. All of these other things come into the assessment that a bank will put you through to determine how much you can actually borrow. But generally speaking, multiply your taxable income by 4 to 5 times, and that gives you an approximation for how much you can borrow. Let's keep it simple. On $100,000 taxable income, as an example, you're likely going to be able to get a bank to give you a loan of about 500,000. The very rough rule of thumb here, by the way, is that if a bank won't lend it to you, it's probably too much to borrow. It's also really important here, though, to note that it's definitely not always the case that it's 4 to 5 times because banks themselves will go through seasons of credit expansion when they're really, really keen to do business and they maybe lower the rules a little bit, the barriers to entry to give away more money. That's credit expansion. And then other times they go through credit contraction, higher interest rates, tougher lending criteria, making it uncomfortable for people to borrow lots of money. It encourages people to repay their debt. That's kind of the environment that we're in right now. Things are getting a little bit hot in here, so a lot of the weak hands are getting out. They're dropping their properties. Maybe they're selling, getting rid of their debt, downgrading properties. That's extreme, but that is kind of what is starting to happen. But let's take a step back here and just think about the big picture if you can. You go to work, you pay tax, and then you get to keep what is left. With this money, you have to buy what you need to run your life, right? You have to pay for a roof over your head, food, for people that are dependent on you. You got to pay for all their stuff as well. But if you've done really well with that, then you've got a little bit of money left over, right? There's a little bit left over that you can spend on the right now, like the lifestyle stuff, and the later on, like the retirement stuff, lifestyle or investments. We may know what it should cost for our groceries or to fill up or even to go on holiday, but often we don't have a sense for what we should be spending on our mortgage. What's normal? Well, here's an approximate guideline, but you do well just to keep in mind that this shouldn't be taken as financial advice or an indication as to what you could or should do with the bank. you would do well to get some advice around that. So if you're targeting, say, 30 to 40% of your gross income on your mortgage, then you're probably in that normal band of people who are in the building up phase of their lives. So if you had $100,000 of gross taxable income, then between $30,000 to $40,000 of that money would be allocated towards servicing a mortgage. Now, you should strike a balance here, though, between your lifestyle and your financial objectives, your right now and your later on. Sometimes this is easy, sometimes this is a bit more complex due to everybody's situation being different. In any given moment in time, when interest rates are high, like what they are right now, or low, like what they were just over a year ago, you may be over or under this 30 to 40% band. But all the while, that should be the acceptable range that you operate in over your entire working life. At the start, you're going to be paying mostly interest on a very large mortgage, which will feel really scary. But later on in life, as your income goes up, your mortgage payments are still really high, but the blend is now mostly on principal. You're repaying the debt far more aggressively later on. But that entire time, somewhere between 30 to 40% is the rough guideline that I'd put out there. This is all about making the most out of what you have in terms of your income, your equity, and your access to the bank's money. Interest rates and house prices will likely always go up and down like a yo yo, but hopefully, as a percentage of your taxable income, you'll stay roughly tucked nicely inside of this 30 to 40% range. This is what most people will naturally do, but often not consciously. Now you know you can do it consciously. Let's talk about interest rates, though. They can be unpredictable. So it's crucial to be prepared for the ups and downs. We've been reminded of that recently. We don't want to fall into the trap of borrowing more when rates are low and property prices are rising, and then selling off property when it starts to drop in value and rates start rising. Having a mortgage which is too large for you means that you're not able to cope with the actual change in mortgage payments should a rate change occur. Borrowing $500,000 on a $100,000 a year income with today's interest rates would give you a mortgage payment which is roughly 38% of your gross income. Now, that's based on an interest rate of around 6.5%. Property values often grow in nominal terms much faster than our after tax income. But in any event, and for many reasons, this rate could be high relative to where we'll be in the next 1 to 3 years. We need to remember that. For this reason, during times like this that we're in right now, we need to be open to having much higher mortgage payments just to get into the market. And for those already in the market, things will get easier in the future. We just have to stay put. This is a cycle that we all go through from time to time. The bottom line is this: only borrow what you can confidently repay within your borrowing time horizon. But be flexible and make allowance for changes in the interest rates between now and then. Be confident around your own budget, around how much you can actually afford, considering the stage of life that you're in right now, whether it's your first home or your last home. We've built a fantastic self-guided DIY online personal finance course called New Wealth Foundations. And if you haven't yet checked it out, then check it out. There's a link in the notes of this episode, and there's a special offer code. You use that offer code at checkout, you're going to get 50% off for the entire month of May. So go for it. Fill your boots. It wasn't that expensive to start with, but it's a lot cheaper now. There should be no excuses to do it. Enroll now, do the course. You're going to learn the basics on how to condition your cash flow, how to set some goals that will actually stick. And you'll learn about the basics of investing, like what's a managed fund and how do alternative investments actually work. So jump in the notes, check out that referral code, go and check that out now. We got free weekly webinars for the rest of May and June, so you don't want to miss that. Now, that wraps up our first video in this exciting 3-part mini series around mortgages. Don't forget to subscribe and hit that notification bell so that you don't miss it when the next installment comes through. Thank you very much for listening in, and we'll catch you on the next one.